Gold and silver just did something they have never done before in the same week, in the same market cycle. They crashed 46% in a single session, the worst collapse in 46 years, and then 3 weeks later came all the way back. Gold is sitting at $5,000 right now. Silver is at $78. And every trader, every stacker, every industrial buyer on the planet is staring at the same screen asking the same question. Was that the bottom? Or is the real crash still coming? I've been going through the data for the last 72 hours, and what I found is not what most people expect. Because right now, at this exact moment, there are two forces moving this market in opposite directions, and they are both more powerful than anything we've seen in this cycle. One of them points to silver above $100 before March ends. The other points to a retest of 64 and the margin calls that come with it. By the end of this video, you will have a framework, 4 specific scenarios, 5 real indicators, and the one date, 9 days from now, that changes everything. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now, because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it before the window closes. Now, let me show you exactly where we are, because the recovery looks clean from the outside, and it is anything but. January 30th, silver crashes from $121 to $64 in a single trading session, 46% gone. The worst single-day collapse since 1979. Before that, you have to go back to the Hunt brothers' corner to find anything remotely comparable, and the market has not resolved what caused it. The 8 margin hikes are still active, the COMEX vault is still draining, the institutional shorts are still short. Nothing that created the crash has been fixed. Silver just recovered anyway, and that tells you something important, but it doesn't tell you which direction comes next. Here's what does. Right now, today, COMEX registered silver sits at 88 million ounces. That is the lowest level of this entire cycle. An open interest on March contracts, the contracts that require physical delivery, represents 400 million ounces of promised silver. Read those two numbers again, 88 million. In the vault, 400 million factor promised. That is a 4.5 to 1 gap. For every 1 ounce of real metal sitting in that warehouse, 4.5 ounces exist only on paper. And first notice day, the day every March contract holder must declare whether they want physical delivery or cash settlement, is 9 days away. Think of it like a dam. The physical shortage is the water behind it, building pressure for months. The margin hikes are sandbags being thrown at the base. The question is never whether the dam holds forever. The question is whether the sandbags run out before March 27th. Now, here is the force pushing back against the drain. And this one, I think most people are underestimating. On February 4th, Vice President Vance stood in front of representatives from 55 countries at the State Department and said something that should have been front-page news everywhere. He said the United States will establish reference prices for critical minerals at every stage of production. And for members of the preferential zone, these reference prices will operate as a floor, maintained through adjustable tariffs, to uphold pricing integrity. A floor. The United States government told 55 countries that the free market price of silver is broken, that China's dominance in refining has distorted prices so severely that Western companies cannot compete. And the solution is not to let the market figure it out. The solution is to set a price floor. Undersecretary of State Jacob Hellberg confirmed it on record to Bloomberg. 11 countries have already signed bilateral agreements. The EU, Japan, Mexico. Okay? And the same day, Trump unveiled Project Vault, a $12 billion critical minerals reserve. $10 billion from the Export-Import Bank, $2 billion in private funds, specifically designed to stockpile strategic minerals and stabilize prices. I want you to think about what this means. The United States government looked at silver at $74, 3 weeks after the worst crash in 46 years, and said, this price is too low. The market is broken. We need to put a floor under it. The government of the United States is telling you the current price of silver is artificially suppressed. And here is what confirms it from the other direction. Hecla Mining, the largest silver producer in North America, just released their full year results, revenue up 53%, net income 9 times higher than the year before, 9 times in 12 months. But those are not the numbers that matter. This is the average market silver price for the fourth quarter of 2025, the benchmark, what COMEX said silver was worth, was $54.83. Hecla's average realized price, what industrial buyers actually paid them, was $69.28. That is a $14 premium. nearly 30% above the market price, not in Shanghai, not in some private arrangement, in America, reported to the SEC, on the record, audited. How does a mining company realize 30% above the market average? There's only one explanation that makes sense given everything else we know. Industrial buyers are going directly to the mines and paying whatever premium it takes to secure physical supply because they cannot trust the exchange to deliver it. We already know Samsung locked up 100% of the output from the La Paria silver mine for 2 years through a direct prepayment deal. We already know London lease rates hit 34% in October because institutions were desperate to borrow physical metal. And now, we have the largest silver miner in North America confirming the same pattern from the supply side. The mines are getting more than the market price because the market price is wrong. And here's the part that kept me up last night. Chinese markets closed for Lunar New Year on January 29th. They have been closed for 3 weeks. The buyers who pushed Shanghai physical silver to $99, while COMEX paper said $78, have been out of the market the entire time. They come back on February 24th, 4 days from now. A $21 gap between what physical silver trades for in Shanghai and what paper says it's worth. And that gap was built without Chinese buyers in the room. What happens to that number when 1.4 billion people's industrial buying machine switches back on? I don't know exactly, but I know it does not narrow by the paper price going up. It narrows when someone runs out of metal to sell. And while all of this is building, APMEX, the largest online precious metals dealer in the United States, published a letter from their CEO on February 17th. Ken Lewis called this past month, and I am choosing these words carefully, one of the most extraordinary periods the precious metals market has ever seen. His company, with decades of experience and massive warehouse operations, added 4 extra business days to every shipment, reduced their catalog to 31 products, increased customer service staff by 25% just to handle the volume, and saw weekend order levels 7 times above normal, 7 times. After a 46% crash was supposed to kill demand. The crash didn't kill demand. It scared retail buyers for 2 weeks. The institutional buyers, manufacturers, sovereign funds, the people who need physical silver for semiconductors and solar panels and defense systems, they did not stop. They accelerated. And now, sitting on top of all of this, there are 35,000 call options on March COMEX. Silver futures that are in the money right now. Options that give the holder the right to buy silver futures at prices below where silver is currently trading. The banks tried to kill those options on January 30th. They crashed silver 46% in a single session, specifically to knock those calls out of the money. It did not work. Silver recovered. 35,000 calls survived. Each COMEX silver contract represents 5,000 ounces. 35,000 calls, if exercised, represents 175 million ounces of potential delivery demand. The vault has 88 million ounces. The math does not work. Now, will all 35,000 exercise? No. Most options traders take cash. But we are in an environment where industrial buyers are paying 30% above market price to get physical silver directly from mines, where Shanghai charges 20% above paper, where the largest dealer in America couldn't ship for a month. In this environment, the incentive to exercise a call and take physical delivery, rather than cash, settle, is higher than at any point in modern history. Because if you can acquire COMEX silver at 78 through an exercised call and sell it to an industrial buyer at 99, that arbitrage is real, and smart money knows it. Now let me give you the 4 scenarios, because depending on which one plays out, your position either survives this or it doesn't. Scenario 1. The delivery crisis triggers, enough call holders exercise, demand physical delivery, and the vault math breaks open. Emergency cash settlement is declared force majeure. The paper price loses all credibility as a reference point for physical metal. In this scenario, gold does not stop at its January all-time high. Silver does not stop at 100. The repricing is violent and fast, and there is no time to position after the headline breaks. Probability, 25%. Low, but maximum impact if it happens. Scenario 2. Chinese buyers return and the price floor firms up. February 24th, Chinese markets reopen. The physical premium in Shanghai widens further. The U.S. price floor gets formally adopted by additional allied nations. Industrial buyers accelerate direct mine purchases. COMEX becomes increasingly irrelevant for price discovery, not all at once, but gradually and then suddenly. Gold grinds toward 5,500. Silver recovers past 90 over the following weeks. This is the base case. Probability, 45%. Scenario 3, another coordinated margin hike before March. CME raises margins again, before first notice day, triggering another forced liquidation cascade. Paper silver retests 64, maybe lower. Physical buyers Manufacturers, sovereign funds, the people who were already paying 30% above market, treat this as an accelerated buying opportunity. The gap between paper and physical widens to $40 or more. This scenario is brutal for anyone holding leveraged paper positions. It is irrelevant for anyone holding physical. Probability, 20%. Scenario 4. Iran deal and tariffs struck down simultaneously. The war premium evaporates. The Supreme Court invalidates the tariff regime. The dollar strengthens. Risk on returns. Gold pulls to 4,500. Silver back to 70. This is the only scenario with a meaningful short-term bear case for metals. But even here, the comics vault does not magically refill. Hekla's industrial buyers do not stop paying premiums. The price floor does not get unannounced to 55 countries. A short-term correction in a multi-year structural bull market is not a reversal. It is an entry point. Probability, 10%. Now, 5 things to watch over the next 9 days. Not price levels. Those are noise right now. These are the signals. The Comics Weekly Vault Report, released every Friday. Is silver still draining at 20 million ounces a month? If the drain accelerates, scenario 1 is moving closer. The Shanghai Premium on February 24th. When Chinese markets reopen, does the gap widen or does it finally start closing? If it widens, physical is screaming. March open interest. Are traders holding delivery positions despite the crash and the margin hikes? High open interest going into first notice day means delivery pressure. Low open interest means the bank succeeded in shaking out the longs. Any new CME margin hike announcement, another hike activates scenario 3 immediately. Watch for it. An official price floor bilateral announcements. Each new country that signs means scenario 2 is accelerating. These are not just numbers. They are the warning lights on a system that is already under stress. If you are holding physical gold and silver right now, what you hold is the asset the US government just told 55 countries is underpriced. Don't let a paper price, printed by institutions that are short, tell you what your metal is worth. If you are thinking about buying, understand this. You're not trying to time the exact bottom. You're trying to be positioned before February 24th, before first notice day, before the next headline moves the price 10% in a session. In markets like this, waiting for certainty is how you miss the move entirely. And if you hold paper silver, futures, ETFs, leveraged products, January 30th showed you exactly what the system does when prices move against institutional shorts. It changes the rules, it raises margins, it halts the fund, it locks the exit. Physical metal cannot be margin hiked out of your hands. You can print a futures contract, you can crash a paper price, you can halt an ETF and lock the exit door while your customers watch their accounts drain. But you cannot manufacture 88 million ounces of physical silver overnight. And you cannot put metal back into a vault that the smart money already emptied. The floor is being built. The question is only whether you are standing on it or underneath it when it locks in. This is my opinion, not financial advice. Your money, your decisions. Drop a comment and tell me which scenario you think plays out first. Delivery crisis, Chinese buyers return, another margin hike, or the Iran deal kills the rally. I want to see your thinking. Share this with one person holding silver right now who doesn't know that February 24th is a date they need to watch. One share gets this in front of someone who needs it before the window closes. If you haven't subscribed yet, do it now. I'm covering the comics, vault data, the Shanghai Premium, and the first notice day every single day in real time until this breaks. This is the hidden economy. Stay sharp, stay stacking, and I'll see you tomorrow.